Welcome to the Everyday Investor. My name is Nicole Edmonds. I'm filling in today for Rav Toor, and today we're going to be talking about how we can make significant returns by partnering with the builder. We'll be talking about investing in land development and how we can make those returns simply by writing a check. Grab your pen, grab your paper, and don't go anywhere. It's going to be a great show. Today we're going to be talking about how we can make money by partnering with the builder. I'm here with Darcy McConvey. He's the Senior Vice President of Private Capital Markets with Greybrook Realty Partners. Darcy, welcome to the show.
Thank you very much. Great to be here.
So, Darcy, I want to get into talking about land development, but first, I understand you grew up playing hockey, professional hockey.
I did. Well, I grew up playing minor hockey and ended up sort of as a semi-pro, pro hockey player. I guess like most sort of young Canadian boys, you know, hockey seems to be in our blood. But yeah, played hockey in Toronto in the GTA throughout my minor hockey, and then into Division I college hockey in the States, and then I ended up playing in Dallas and Vancouver system, and then in Sweden and Switzerland sort of to finish off.
Very cool. So how did you end up getting involved in land development?
I have a bit of a sort of, I wouldn't say it was necessarily a straight line to get where I got. You know, it wasn't really a master plan, but I've always had a deep interest in real estate, it's particularly on the development side. But sort of when I was done hockey, I got into more of a traditional finance role, and from there I did a grad degree in business school, and then had right out of business school with a good friend of mine who was a lawyer. We started a sports recruiting company, ended up selling that business. So I have a bit of an entrepreneurial background and sort of the entrepreneurship in my blood as well. And it was somewhat opportunistic. A couple of the partners at Greybrook I knew quite well. And, you know, obviously I had the interest, had a bit of a finance background. So it was almost like sort of the stars aligned, and I ended up at Greybrook, and it's a great place.
Very nice. Well, I'm excited to talk to you today. I know Rav invests pretty much solely in land development now.
Right.
Since he's told me about it, my family started investing in land development. But I think a lot of people, when they think about real estate investing, they don't necessarily know that land development is an option to them. Would you say?
Yeah, I think that, you know, when you think about investing in real estate, it's the traditional way that we all do it, right? We buy a home or buy a second or third residence and try and sort of rent it out for cash flow, pay down sort of your principal and build up your equity. And a lot of people have done that in history, and it's a great way to invest. But sort of the way we look at what we do is more on the manufacturing side. You know, you see sort of developers, and they often do quite well financially, and I'm sure a lot of people look at them and say, wow, wouldn't it be nice to be able to sort of do what they do and drive the returns and sort of build up my wealth like they have. But I know that's not necessarily why people always invest. But so yeah, it's definitely a unique way to go about it, and like I said, it's sort of we call it manufacturing, right? It's what's it cost to build versus what you can sell it for, and sharing those profits.
Okay, so how is it then that we who aren't developers, myself, Rav, yourself, could get involved in that as an investor, but without that experience?
Sure. So I guess just Greybrook holistically, we allow sort of everyday investors the opportunity to invest in as owners and participate in sharing the profits of some of the largest developments. We do it in the GTA, Greater Golden Horseshoe, and also in South Florida. But basically, Greybrook has created a structure where sort of individual investors can invest as low as $25,000 per investment, and obviously more. So they invest in single projects. We do anywhere from 5 to 7 projects a year, where you know, and we generally target a return of 20 to 25% annualized in all of our projects.
Okay, so that's very unique that, you know, as an investor I can be involved in a passive investment.
For sure.
And be making those kinds of returns. Very interesting. So who are some of the people investing in these deals? Is it kind of just the everyday person? Who do you have that come and invest in these deals? Yeah,
you know, it's kind of an eclectic mix, right? We've got the everyday person, like dentists, lawyers, doctors, professional people. There are certain financial sort of minimums that you need to sort of meet in order to qualify, and then upwards of, you know, small funds, some small pensions, and high net worth families. So it's really an eclectic mix. We have about 4,000 active investors, so a broad base, and I would say it's a very sticky and loyal and good investor base.
And these are Canadians? Do you have to be Canadian? Do you have to be from Ontario? You said you're doing GTA and South Florida, so does it matter where you're from to get involved?
The bulk of our investors are Canadian.
Okay.
So we're a regulated entity, so the bulk of our investors are Canadian, but we do have sort of foreign investors as well, some from all over the world. I think we have investors from 30 plus countries globally, so but predominantly Canadian. And
so we're talking big projects here. We're talking like high rises, or what kind of projects are these?
Yeah, so I kind of, the way I classify what we do is we do sort of anywhere from 50 to sort of 200 townhouse development, 50 to 200 home developments. So those would be usually 3 to 4 year projects. Then we go into single or multi-phase sort of condo development. Oftentimes these condos would have a mixed use component to them, meaning that there'd be a commercial component in the bottom sort of 1, 2, 3, or 4 floors. Mm-hmm. And then we'll go up to what we call a master plan community, where you're building 300, 400, up to 1,000 homes. And those can generally take 4, 5, 6, 7 years. So anywhere from small, I'd say as small as 50 homes through 1,000 plus
mm-hmm.
homes.
Okay, very cool.
Yeah.
All right, we're going to take a quick break. When we come back, more to talk about investing in land development. When you're considering investment in real estate, always ask 4 questions to start. 1, what is my return on investment? 2, when do I get that return along with the money I put in? 3, what is the minimum cash amount needed? And 4, what is the risk in the worst case scenario? Welcome back to The Everyday Investor. I'm here talking with Darcy McConvey. We're talking about investing in land development. Darcy, we were just talking about, you mentioned that some of the returns on these land development projects are 20-25% returns?
Yes, that's right.
That's very interesting from a passive investor perspective.
Sure. I'm
interested to see kind of how we can attain that. I think you've got a bit of a chart that you're going to draw out for us.
I was not an art major,
okay.
But I think the best way to sort of display sort of how the returns work, because oftentimes you're right, a lot of people saying, well, passive investment, how can you ever generate 20-25% returns on an annual basis? Mm-hmm. It seems too good to be true.
Yeah.
So I can sort of draw out a simple example of one, sort of how the returns are made, but also sort of how development works, and I think it will be very helpful.
Sounds good.
So let's go for it.
Okay.
So I'm going to jump on this side of this
sure.
of the chart. So we call this sort of a capital stack, but basically in any development, sort of the initial phase, we're going to buy the land, and sort of what we do, we acquire the land, and then we pay for some soft costs, sales and marketing expenses, sales center, okay. Planners and consultants. And so that requirement is typically called equity. So in any development, equity, and again, this isn't a hard and fast sort of rule, but this is just good to see on a percentage basis sort of how it works. So we'd say equity is usually 15%, and in this case I'm going to use $15 million, so equal to 15% sort of any development.
Okay.
Right? So the next sort of 15%, and when I say 15%, I'm talking about of total cost in a development, would be sort of your deposits. Okay?
Okay.
Sorry if my writing is not
those deposits, they're also going toward those soft costs, like you're saying, sales as well, or are they actually going toward the construction?
Sometimes they can be going towards the construction. Sometimes they're just held sort of as deposits to sort of get ultimately sort of the next step in this would be get your construction financing.
Okay.
So it's sort of the equity, the total equity requirement plus deposits in order to get your construction financing.
Okay.
So the interesting thing about the deposits are, I think most people have heard or know about, in Toronto, especially on the condominium or high-rise side, you have to pre-sell your building. So we're all used to sort of walking in a sales center and buying a unit off spec. Mm-hmm. So you have to pre-sell up to a certain threshold before you can get your financing to actually build, right? So that's what these deposits are. These are the pre-sale deposits that you'd put down when you walk in a sales center and say, hey, Darcy, I love this development, I love this unit, and I'm going to put a deposit down to sort of secure your unit.
So you're saying this is what's needed to get the financing from the bank, for one.
Yep.
But this is also good, if I was an investor, to know that there's pre-sales happening before we're spending all this money to develop.
For sure. So that's a great point, right? So here's your bank financing, right? And this is going to be, say, 70 million or 70% of a development. So that's a great point. Sort of in the late 90s, buildings used to be built on spec, right? So basically, they would build a building, then hope to either sell it or tenant it. And then what happens when you can't tenant it? The banks are held on sort of the hook for putting all this financing out there. So they said, well, hey, how about this? Hey, Mr. Developer, why don't you pre-sell your building before we give you your financing, right? So this is sort of something that, for sure, if I'm an investor and I know, so we inject sort of our investment as Greybrook, and we've acquired this site and we have intentions to build this development, but you don't get your construction financing to effectively get into construction until you've pre-sold to a certain threshold. And that threshold is sort of determined by the bank. And really it's the bank wanting to see that, that there's enough sales in this development so the bank will at least get its money back, or there's enough profit in the development so that the bank feels comfortable lending because they know that they'll sort of get their bank financing back.
Okay, makes sense.
Yeah. So 70% or 70 million in any development would be bank financing, right?
And sometimes that's common that they would need 30% down, 30% in actual cash before they'll give you financing.
Yeah, so in this case, we're saying it's 15% cash, give or take 10%, right? It could be up with 25%. And really, I would say it's less about the cash and more about, you don't want to be putting a lot of leverage on the land. So if you can buy the land for all cash or for very, very sort of reasonable amounts of debt, at Greybrook, we call it using responsible leverage. If you can do that, then you're going to own the land. You're never going to be forced to sell it. You feel like in up and down markets, you can carry it. So the equity component is really enough whereby you're not going to have to put too much leverage or too much debt into a project.
Okay.
Yeah.
Makes sense.
So the next component. So now this is a great project. It's cost us, say, 100 million to build it, and it's going to make 30 million in profit. That's an ugly square. That's right. So it's making 30 million in profit. Now in the Greybrook structure, this 30 million is effectively split 50-50, 50% to investors, 50% to the developer.
Okay.
Obviously contact us to understand this a little bit more. But in the case, for simplicity's sake, we'll use sort of a 50-50 split, okay? So we've got 15 million to Greybrook, 15 million to Mr. Developer.
Okay, and down here when we were talking about the equity portion,
yeah.
So that's the money that, I guess is that where the investor money is coming in?
It is.
Okay.
So sort of, I don't know if you can see sort of below this board, so I'll bring it up here. So of that 15 million, typically 80% of that would be Greybrook.
Okay.
And our investors. 20% of that 15 million would be the developer. On the equity side,
yeah.
Right? So in this case, that would mean as investors in this project, Greybrook and its investors would be putting $12 million into the project. And this is again on the cash equity investment. The developer would be putting in 3.
Okay. And so obviously the investors are putting in more capital than the developer. Are the developers doing all the work? Is Greybrook doing some of the work as well? Or
That's a great question. So it's a passive investment for investors, right?
Okay.
It doesn't necessarily mean it's passive for Greybrook internally, right?
Okay.
So we basically the responsibilities are the developer's responsibility is really to market, sell, build, construct, complete. So they sort of have a lot of the build and development expertise, and obviously we're partners, so we want the partnership to be a good partnership. We don't tell them necessarily what to build or how to build it.
Okay.
But we do have sort of deep development expertise in-house. We've got people from some of the biggest developers in Ontario. And like I said, they have very deep knowledge of how development works. So they know costs, they know, the stuff inside out. So we actually co-manage all of our developments. So again, we don't tell the builder developer what to do or how to do it necessarily, but we're co-managing it. So we're going to look at costs, we're going to look at budgets, we're going to even contribute to, sales and marketing at times.
Yeah.
So that's one thing as an investor that I would be, very concerned about and probably quite happy to hear that I'm not just injecting my money into development and saying, hey, Mr. Big Developer Guy, go nuts. I hope you build a great building. We are actually, Greybrook is managing those funds on behalf of our investors, and we do it with deep expertise, really understanding development inside out.
So we're investing our money with you guys, and then you're managing the relationship with the developer and looking out for us, the little investors.
Exactly, just co-managing the project, right?
Okay.
And as a sort of a, like you said, little guys like us, little guys like you and I, that's what you'd want, right? You'd want people with expertise. You want people that are going to put a structure in place that's going to protect you, particularly on a downside. And you want all these things, sort of someone looking out for your best interest, right? And so our goal effectively is to minimize risk, maximize return for our investors.
Okay.
And this is sort of how we get to that return.
Okay, I'm going to come over to this side.
Sure.
All right, so we're getting paid out 15 million return.
Yep.
And we're in for 12 million. What are the timelines like for these projects?
Sure. So it can vary. If we're doing a smaller development, like say we have an example of a 50 townhouse development, that can be 3.5 years. A single tower condo sort of type development could be 5-6 years, 6+ even. Actually 4 through 6 years. And then you get into sort of our bigger developments that are multiple phases. Where you've probably seen, these developments sort of launch phase 1, phase 2, phase 3, and typically pricing goes up while that happens.
Yeah.
But those can be, 5, 6, 7 years. So this example I'm giving here is more along the lines of a 4 or 5 year project.
Okay.
So if we look sort of back to where it all began, we put 12 million in, developer put 3. So now if we sort of put that back on the board over here, GB, I don't even know if that's legible, but I hope it is, and 3 for the developer. So if you're an investor and you say, well, how is it possible that I can generate a 20% or 25% annualized return?
Right.
If this is a 5-year project, you got 12 million in, so you get your 12 million back plus an additional 15, which I guess is a return on investment of, not dollars.
125%.
125%.
Okay, because we're taking our profit, our 15 million, and you can do this at home on your calculators. We're dividing it by the money that we put in, which is the 12 million.
Right.
We're getting 125% return on investment, but that's not every year. We're dividing that out by the length of the project. So if this is a 5-year project, we're making a 25% return on investment per year. Now, are we getting that money every year, or do we get it at the end of the project?
So great question. So 25% annualized is sort of what that relates to. So because this is a profit sharing, it's not cash flowing throughout, right? So it's development, so there's a lot of cost in development, and then the profits sort of are realized at the end of the project. So typically you're going to be, invest in day one, and then the profits will be realized and shared at completion, or what we call material completion, which could be 90% or 95% or 85% of the units could be sold, and there's enough money to pay back the bank financing, get the investors their original investment plus the bulk of their profits back, and then maybe as the last 2, 3, 10 units sell, there's small distributions back to investors until they're all sold, and then that's that. Okay,
so then when we're talking annualized, just for the viewer at home, when we're talking annualized versus annual, we're taking that return, dividing it out over the number of years. So it is different than talking about an annual return.
Yeah, it is. So you don't see it annually, but it's just the length of time of the project, the total return divided by the number of years that the project takes.
Okay, makes sense.
Yeah.
And so this is kind of the structure that you're using for all different projects, or is this more specific to a condo or townhouses, or?
Yeah, no, I think it's just a good baseline to understand sort of how it works, why the returns are what they are, and how sort of the manufacturing process works. So here's your sort of what it costs you to build a widget or a condo, and here's what you can sell it for. Obviously, if you can control your costs, which again is what we're going to co-manage the project to effectively do that well, and grow your profits, then it's a great thing. So I would say that there is a bit of difference sometimes in sort of a phase development. So if you think about sort of what we talked about, we call them master plan communities, where you're doing 300 homes plus. Say you do them in blocks or phases of 25, 50 homes.
Yeah.
That, you know, typically you don't need to pre-sell 70% of those units before you can start building the first home, right? Because a condo is sort of binary by nature, you sort of have to pre-sell it and then you build this one big building.
Makes sense. Hold that thought, Darcy. We're going to cut quick to a commercial break and we can pick up where we left off. Stay with us. We're talking more about investing in land development when we come back. Did you know that as of August 2016, the average price of a GTA home has increased 17.7% since 2015? Constrained housing supply across the region has increased demand and in turn fueled surging prices. Welcome back to The Everyday Investor. I'm Nicole Edmonds, filling in for Rav Toor. Today we're talking about investing in land development, but before we go further, we're going to check in with Carmen Campanero from Pro Funds Mortgages to see what's going on in the world of mortgages. Carmen, I'll pass it over to you.
Thanks, Nikki. I wanted to talk to everyone today about the interest rates being so incredibly low. I mean, this has been a history of timelines where interest rates have remained so low for such a long period of time, and there aren't any serious indicators of them going up. So for you folks out there, I highly recommend you take advantage of buying that condo, refinancing your home, refinancing any of your investment properties that you may own, and use that money to invest in a mortgage investment. Right now we're looking at rates at 2.2% for a variable, and if we're looking at a fixed 5-year term, we're seeing things as low as 2.4 and 2.5%. Now I will mention that there are options to buy down interest rates if you have a very favorable deal. So that can happen as well. So you can get below the 2.4% interest on your residential mortgage, strictly residential. Thanks. Back to you guys.
Thanks very much, Carmen. So I'm here with Darcy McConvey. We're talking about investing in land development. And Darcy, we just talked about kind of how the investor's money goes in, how everything's structured with investor money, developer money, getting a mortgage as well for the development. One thing I want to ask you though, so we saw the kinds of returns coming out of these deals. Why does the developer want to share that with us? They've obviously been doing it for a long time. They're making these big returns. Why are they sharing that with us?
Sure. So I think, you know, historically where, you know, a lot of developers do use their own money and don't sometimes partner. But if you look at development just sort of broad-based, you often see multiple, you know, developers on a project, and partnerships are sort of, you know, have always been around, right? So it's not like we're necessarily reinventing the wheel with what we do. But so I guess to step back, you know, one of the reasons we work with the developers that we do is because they probably actually don't need our money. And that's a good thing, because if they did, then maybe you wouldn't want to sort of partner with them potentially, right? But sort of aside from that, if you look at sort of the returns that sort of that capital stack that we showed, you know, we actually give the developers significant returns as well, right? So the return on their own equity that they're putting in projects is very good. And why that's important is that allows them to do sort of multiple projects out into the future, right? Because a lot of these developers are going to be large, oftentimes vertically integrated, meaning they'll go from buying the land all the way through to developing it over, you know, a huge number of years. So we just give them ability to scale and do multiple projects, buy land out into the future. So it's really, you know, they're leveraging their equity, and we're sort of giving them the ability to scale. Because even the biggest, you know, at some point, if you're putting all your money in projects, you may run out of money, right? And so that's where the sort of the nature of partnerships is good.
Because we showed 50% return on investments going to the investors and 50% to the developers, but that's not what we were both in for, right? The investors are bringing more money to the table, so that makes sense. Then the developers can actually spread their money out, make 50% on multiple deals versus 100% of one deal.
There you go.
Okay,
exactly.
Makes sense.
Yeah.
Okay, so you've got for us, is this a timeline that you're going to show us about kind of an example project and what's going on?
Sure, yeah. No, well, it's just sort of highlighting sort of how land value, and how land value increases over time and the different stages in development sort of that occur. This is obviously very high level, and there's, a lot of permutations in between all this, but sort of the way we look at it is we sort of classify it into 3 different stages, right? So there's the entitlement stage, the approvals and planning stage, and then the sales and construction stage, right? So your entitlement stage, I'll just sort of draw, how we see land value changing in time.
So, sorry, what's entitlement?
Yeah.
What is that?
So entitlement is basically, when people say sort of what's one of the risks in, what are the risks in investing in Graybrook? And so, one of the things that we don't do is take what's called entitlement risk. So entitlement risk is effectively buying, agricultural lands or, employment industrial lands and trying to rezone them for residential development, right? So if you do that, you usually get a big spike in sort of the land value if you can change entitlement risk. So if I take an agricultural parcel of land and can rezone it to residential, you get a real large lift because that residential land is effectively worth more than the agricultural land, right?
So you're not taking the risk of potentially buying it and then not being able to change it.
Correct.
When you're getting in, it's already been approved.
So clearly here you can do quite well by doing that. You get a big spike in the land value, but it's risky and it can take time, right? And sometimes you can't predict the time. And in fact, I would say sort of the legislation in sort of the GTA and in Ontario is getting more restrictive and constraining. So this may take even more time sort of headed forward, right?
Okay.
So the next phase is sort of planning and approvals, which is basically getting your, your site, the plan that you have for your site, what you want to build, fully approved. And sometimes that can take sort of a long period of time. And as you're sort of completing your approvals, getting your approvals and doing planning, the work you're putting in is going to be increasing your land value. Because at this point here, you can effectively build on the land. Okay,
so even though we haven't actually built anything here, even just getting those plans in place is increasing the value?
Absolutely.
Okay.
Absolutely. So here's your draft, it's called draft plan approval, effectively. So this is kind of so you've taken it now through the approvals and planning, you're not taking entitlement risk, and now at this point, you can sort of start your sales and construction.
Okay.
Right? So this buying the land here is effectively buying the land where you can build on it tomorrow. Is sort of how we bucket it. So just so people understand that Graybrook, we sort of play, from this point forward. So in the planning and approvals, anywhere from a 6-year project to a short 2.5, 3-year project.
So we're not necessarily always buying at this point. Sometimes we're buying at this point and getting our profits just for the construction and sales phase.
Exactly.
Okay.
So we'll, it depends on the project. Obviously, when a project comes to us. So just so people understand, we don't go out looking for sites to buy, right? So we don't have a team of people saying, hey, I want to buy this parcel in Brampton or whatever. So we have sort of a roster of 10 or 12 developer partners, and many of them you can see on our website, Tribu, Stafford, Sobara, and basically they have land acquisition groups and they bring us sites, and then our internal sort of banker asset management guys, the guys with the development expertise, will look at it and say, does this check the boxes? Are we going to be able to drive the return that we think we will? What's the sort of status of the environmental, the municipal planning and approval?
Okay.
And so that's how we sort of come across our sites. And yeah, it'll be, anywhere in this range.
Okay. So how many projects in a year would you say are coming to you guys that maybe you do go forward with and some that you don't, I would imagine?
Yeah, I would say, anywhere around 100 projects would come to us, and we would do, 5 to 7, maybe up to 10. Okay. Sometimes it would be more than 100.
You guys are picky.
Yeah, exactly.
That's
and
good.
I think you have to be, right?
Yeah,
and
that's what investors would want, for sure.
I think so.
Yeah.
It's not about the number of projects that you do, right? It's about the quality of projects, and obviously, if you have a lot of investors, there's a lot of people that want to invest in these types of opportunities, which is understandable. But having said that, again, it's about quality, because you want sort of to have a clean track record.
Absolutely.
And the second you The second you don't, you sort of ruin everything you've built, right? So it's definitely about quality.
Okay, so you've brought, just so we have kind of an idea of what we're talking about, you've brought some examples with you today. Could we maybe share those for the viewers, just so we have an idea of what kind of projects we're talking about?
Sure. So this project here is really unique. This is sort of an area called the Lower Junction, and sort of the junction area of Toronto. This building in particular is called Museum Flats. So it's about 170 unit building. It's right at just south of Bloor, just east of Roncesvalles, the sort of the railway tracks. It's right on the Union Pearson Express stop, the TTC. So it's a very good location, and we're actually going to, it's multiple phase, so we're doing 32 townhouses, 3 different sort of mid-high rise condo sites, and then up to 500,000 square feet of commercial. So I don't know if you've seen sort of Liberty Village area, but it's going to be sort of Liberty Village 2.0, I would say.
Okay,
sort of
very cool.
In the junction. So a great site, something we're really excited about. These are the Sky Lofts, so this is a partnership with Stafford Homes, so it's in sort of borderline Scarborough area. And 96 what's called stacked townhouses, so they're condominiumized townhouses in essence. These have sold very well, and it's doing great, and obviously it looks pretty cool.
It does, very impressive.
And then this is the College at Spadina. So this is a project that we're doing with Tribute, 15 stories, right at, hence the name, College in Spadina. Looks pretty neat as well. It's right about at completion. So our investors this year will be getting paid out on this project, which is great. And it's gone, you know, it's actually exceeded expectations substantially. So that's always a good thing to be able to say. Yeah.
So you've got some projects now that are still being developed, some that are completed. Do you have kind of numbers for those? The bulk are still in construction, or what would you say?
Yeah, so we have a number at various stages of development and construction. So I think about 3 of them this year will pay out by the end of this year, which is great. I think we have 18 projects sort of at various stages of development. So from right in the early stage through to, you know, halfway through to sort of right near the end and going to be paying out. Yeah. So, and again, with all of our projects, you know, we're going to always sort of target a projected return of 20 to 25%, and hopefully under promise and over deliver. Yeah, there you go. Yeah.
Okay, very good. So I noticed a lot of these projects, and you said you guys do it a lot in the GTA and South Florida. Let's talk about the GTA for a second.
Sure.
There's always different headlines and things coming out in the news about a bubble or oversaturation. You drive through downtown Toronto and you see cranes everywhere.
Right.
What's your comment on that? I mean, you guys are developing there, so what do you think about that?
Yeah, I think that real estate is definitely a target for headline risk in popular media, and you know what, there have been sort of unfortunate scenarios, so maybe justifiably so, but I would say overall the GTA, like if you look at pricing, which is sort of, well, I guess flip back, if you look at the demand side, so you've got, you know, anywhere from 80 to 100,000+ migrants into the city of Toronto annually. So that means you have to build a certain number of homes. And if you look at the low-rise side, we're effectively sort of almost at historical lows in terms of availability of things to be able to buy. And then on the high-rise side, you know, as we sort of pointed out in that original picture, you're not getting your financing till it's 70% sold. I think the number is 84% of the units being built. So when you see a crane building a building, 84% of those units are sold.
Yeah. Okay.
So obviously there's a buyer. And the supply is sort of at historical norms, and then when you compound that with the fact that, you know, we've probably all heard it before, the Manhattanization of Toronto, with the lake to the south, Lake Ontario, and then this green belt that wraps the north of the GTA, we effectively have this sort of artificial land scarcity that looks a lot like an island, right? So we're constrained in terms of the land that we can build on.
So that's why we're building.
And what we can build, and so why we're building up.
Right.
But because there's limited supply is why you're seeing, you know, prices sort of take off. Obviously interest rates are low and other things, but I think that we're in a very solid market. I think Toronto's a great place to live. I think you see in, you know, a lot of publications, it's always sort of top 5 in a global sort of rating. and sort of Toronto's just catching up to other major markets, right? It's a good place to be, and there's a lot of demand, and I think it's a solid market, to be honest.
Very good. Yeah. Okay, we're going to cut to a quick break. Don't go anywhere. The Everyday Investor continues in a moment. Did you know that over the last 10 years, the average price of new ground-related homes in the GTA has more than doubled? This trend is expected to continue as population growth remains strong, with approximately 100,000 people coming to the GTA annually. Welcome back to the Everyday Investor. I'm here with Darcy McConvey. We're talking through how we can make upwards of 20% return by investing in land development. If you've missed the show, go to rogers.com. You can watch it. It'll be posted there. But Darcy, we were just speaking about kind of timelines for projects. Yeah. So we were talking about timelines, and I'm wondering, why would an investor get in on a 3-year versus a 5-year,
Sure.
6? What's the benefit to me as an investor?
Sure. So I'll draw another, Professor Darcy. I'll draw another sort of little snapshot on here to show you. So if you think about a 3-year project, basically you're sort of going to be buying, and this is obviously not the case for every project. It's just sort of, theoretically. A shorter term project, you'd be buying the land basically like we spoke about, where it's sort of ready to be built on, or they say shovels in the ground tomorrow, right? So if you're doing that, you're basically sharing as an investor in, what it costs to build versus sort of what you can sell it for, or your margin in development, right? Your margin build to sell. And this is, say, 3 years, right?
Yeah, okay.
You're probably getting the land at pretty close to market value, and then, can you build very efficiently and controlling your cost, and then sell well? Obviously, if the real estate market appreciates, which it has been, but if it appreciates, sort of that's gonna help. So that's your 3-year project. But when you get into sort of your 6-year projects or longer, this is just an example, and you're getting the land sort of further or earlier in the approval stage, you have this big uptick in the land value, and then you also share in the margin of development. So your land cost is going to be a lot lower than it would be here.
Okay.
And you really have the ability, I would say, to sort of outperform on the high side. And if you think about it as an investor, you're getting the land at a very good price, so the odds of that land being lower tomorrow than it is today is very unlikely.
Okay.
So I just think there's a greater ability to sort of outperform on the longer projects.
Now, is that because we're factoring in appreciation, we're in it for the longer haul because of that, or is that because this is a bit of a steeper incline right here in the approvals and planning stage?
Yeah, I think there's more value sort of that can be added in the approvals and planning stage. A lot of the vertically integrated developers make the bulk of their money in sort of the land. So just to that point, we actually did an internal case study where we looked at a big site was acquired in 2006, and they started selling homes sort of shortly thereafter. So these homes is a great case study. These homes were basically cost them about $210,000 to build them, and they were selling them for about $260,000. So they're making about $50,000 in profit on a per home basis, circa 2007 or 2008. Now, fast forward 8 years later, land cost is the same because they're still building on the same land.
Okay.
It costs them about $275,000 now to build them, so a little bit more, and that's just a function of construction costs going up, maybe 3% a year. And they're selling them for $740,000, $750,000. So you're looking at $400,000 plus in profit per home. Yeah. Right. So if you think about it, if you're a 3-year project, which most people like because they want to get in and out, right? But if you just sold all those homes in 3 years, you would have been making $50,000 a door. We're now, because of land value and home price, this longer term project, they're making $400,000 a door.
Huge
so you'd
difference.
leave a lot of value or money on the table potentially by sort of doing only short term developments.
Okay. So sometimes though, you guys do projects just in this space. Why would there be benefit to doing that in a situation where you would buy here and sell here?
Yeah, it's I would say it's rare. Like, so we're going to play on this line, sort of, as we've said, in a number of our different projects. Sometimes, you know, we will just sort of cross this line and buy a site here and then sell it sort of at draft plan or site plan approval. And it's just a function of the project and maybe the time, right? Sometimes investors don't want to be in a really, really long-term project. And it could be any number of reasons why. But we feel like sort of we can get a big uptick in the value and sell it, then maybe we would. But that's not our core business, right? Our core business is to acquire, build out, and sort of realize maximum value where we can.
Okay, that makes sense. Okay, I want to go over for our viewers the 4 questions that we always ask when we're getting involved in real estate. So we'll talk about with land development, these kinds of deals. Number 1 is, what is our return on investment? So for these kinds of projects, our return on investment is?
We always project a 20 to 25% annualized return. So our goal effectively is to double investors' capital in 4 to 5 years.
Okay, so when do they get that return?
They typically get the return at, you know, material completion or completion. So when the project is complete, investors are paid back.
Okay. Our 3rd question is, what's the minimum investment? I know you mentioned it briefly at the beginning. Remind us of that minimum investment.
Sure. So minimum investment in all projects is $25,000 in increments of $100. So it's $25,100 or $50,000 or $25,000.
Okay. So it doesn't have to be 25, 50, 75. It can be. Okay. And does that have to be cash? Can I use different monies to do that?
Sure, yeah. So kind of one of the great things, especially when you're looking at sort of longer term stuff, is you can actually invest with cash directly into the project, or you can also use an RSP or TFSA or any other registered plan or LIRA. So, you know, sometimes a lot of these plans like an RSP are sort of long-term investing vehicles where you're sort of deferring your taxes. And so, you know, it would line up well with longer term projects if you can hold in an RSP, which you can.
Absolutely. Yeah, because like you're saying, a lot of people aren't thinking about taking that out
very
soon. And if you can grow that at 20, 25% versus the less than double-digit returns that most people are getting in those registered funds, that's very appealing for people.
So I would say that the vast majority of our projects are registered plan eligible, excuse me. Not all, and that's just really a function of sort of the size of what we would be raising. That's it,
Okay, so we'll call you to find out more about that.
Exactly.
Okay, so our 4th question is, what is the risk? So what are some of the risks with this kind of investing?
Yeah, I think that sort of your biggest risk in a development, look, we structure these to, like we spoke about earlier, to, you know, do everything we can to protect investors' interests from, you know, having a say in the project. Any material or major decisions in the project have to go through Graybrook. You know, like we said, our asset management team is going to be co-managing these developments to sort of de-risk it, to make sure costs and we're getting the right financing and doing all of these things. And then I think sort of if you think on a sort of bigger picture, in development, I think oftentimes your biggest risk is going to be time, right? Can the timelines extend? So obviously, like we said earlier, we want to sort of under-promise and over-deliver on returns and timelines. But, you know, it can be, and we've probably all experienced it. Historically, we've got a very good track record of performing on time, but it can be the case where development timelines extend, right? So if you're someone that, you know, needs that money right at the end of year 3 in a projected 3-year project, then maybe it's not the right investment for you, because it could be that these timelines extend, right? And with sort of timeline extensions, you know, there's something called illiquidity risk. So that would basically just mean that it's not like a stock that you buy on an exchange and you can just sell it tomorrow if you need it. So your money's tied up for the duration of these projects, and you're not able just to sell it at any period of time.
I can't ask for my money back. It's actually being used for construction or to open the sales center or whatever.
Exactly. So you've got timelines, and sort of the one thing that sort of would coincide with that is liquidity, right? But again, sort of we pointed to here, just because a project extends in timeline doesn't necessarily mean your return is going to go down. Right?
If your example is
and just holistically, like if you think about development, it's sort of a long-term thing, right? Like time is usually your ally, is one of the sort of the things that we say in development, right? And developers have done so well because they have the ability to wait and they have the ability to go through up and down markets, and again, time is their ally, right? So just because a project extends doesn't necessarily mean that it's going to carve into your return. It could actually be a benefit, right?
Okay, and to get involved in these deals, can anyone get involved? Is there any sort of criteria?
Yep. So we are registered. We're regulated by the Ontario Securities Commission.
Okay.
So that's basically the the regulator that governs financial services, just like stocks and bonds. But so to invest, you need to either be an accredited investor or eligible investor. Eligible is sort of the lower of the two, in that there's certain criteria, and I can just go highlight them briefly. It's either $75,000 in income a year as an individual,
Okay.
or $125,000 combined income with a spouse, if that's applicable, or $400,000 in net assets. So net assets would be any financial assets like mutual funds, stocks, bonds that you would have,
Okay.
plus any equity in your homes.
Okay.
Yeah.
So, and this is for an eligible
That's for
investor.
eligible. And then
Okay.
accredited is a bit higher of a threshold.
Okay.
But yeah, so people have to meet these minimum financial criteria in order to be able to invest.
Okay.
Yeah.
All right. Can you walk us through this? This all sounds very appealing. What if I want to become an investor? What's kind of the process that I would go through?
Yeah, I think the first step would be get a thorough understanding of what you're investing in, right? So I think your first step would be email or call us at Graybrook, and we have a number of sort of registered, called dealing representatives, but investment professionals that can sort of help you understand the different projects, and then sort of walk you through next steps to actually become an investor. First step would be qualify as either eligible or accredited. And then, if you do that, as projects come up and you tell us that you want to see them, we'll send them to you sort of ongoing until you find one that you like. And I think that's one thing that we, I guess it's sort of made clear, but we didn't really highlight, is that investors are investing in a project by project basis, right? So we do 5 to 7 to 10 projects a year, whatever the number is, that year. But as an investor, you're going to be investing into a single project, not into a fund, and then we're investing on your behalf.
So do I get the details of the project?
Yeah.
I can see what it's going to look like and
Exactly.
where it's going to be?
Yeah, and I think that's one of the things that investors like, right, is the fact that it's sort of tangible, oftentimes in their community, right? So yeah, you'd get, with every investment, we send out sort of investor materials, and that would be, where the project is, the location, the site, how much money we're raising for, what we're building, 50 townhouses, a condo, or whatever it is. And then sort of why we think it's an appealing investment, obviously, and then how we get to our return. So we show how, ultimately how we drive the returns that we do, and it's based on selling at this price and this, and we show comparables. So it's pretty fun and interesting. I think people like looking at it, and I would say the one great thing about that is that, yeah, if you did have a preference because you live in, Richmond Hill, and you want to invest in a King City or Richmond Hill project, and if we have one, you can do it.
Okay.
Yeah.
Okay, very cool. Well, it sounds great. What do you say to people who say it sounds too good to be true?
I just say, one, if I have a napkin, I draw them that picture and show that, this is just the margin in development, right? And so you're getting an opportunity to invest and share in that margin in development that has, for years, always existed. It's just we haven't had the ability to access it, right, as individual investors. So it feels probably a little bit uncomfortable for people at times, especially if they haven't seen sort of these visuals and how it all works. Just because
it's really nothing new. It's the way that developers have been doing it for years and years,
Exactly.
and now we're just getting an avenue to get involved in that. Is that
Exactly.
right?
And I think it's just people have a baseline of whatever they're getting in their registered plan or mutual funds of 5-6%, and so anything way higher than that feels a lot uncomfortable.
Yeah. Makes sense. All right. Well, we'll be right back with some closing thoughts. You're watching The Everyday Investor. If you have any questions pertaining to this show, or if there's a topic that you would like covered, please visit www.rogerstv.com. We're back on The Everyday Investor. I'm here with Darcy McConvey from Greybrook Realty Partners. Darcy, some closing thoughts about investing in land development.
Yeah, so I think, a lot of us, myself included, have always seen sort of some of these great large developments and developers and wondered how you could ever sort of participate in these types of things and share in sort of what's being built, right? And I think we give sort of the everyday investor the opportunity to do that, right? To invest alongside the biggest developers in sort of the GTA, Greater Golden Horseshoe, and to share in those returns. And it's exciting. I do a lot of projects. It's tangible, and sort of it's a really neat way to invest in real estate in a passive way, and generate some significant returns. So it's a great sort of option and way to invest. Very different than probably what people are used to or familiar with. And although it can seem somewhat complex and different, we definitely would tell sort of viewers to contact us, either website, call, and we can sort of simplify it for you and walk you through the process, and hopefully, one day you would be an investor as well.
Yeah, I agree. It's very different from, flips, student rentals,
For
tenanting
sure.
a property, renting out. So it's been a very enlightening show. Thank you very much.
Thanks for having me. Appreciate it. It's been great.
You've been watching The Everyday Investor. On behalf of myself, Nicole Edmonds, Rogers TV, we'll see you next week, same place, same time. See you soon. Guys.